From offshore accounts to trust, companies and LTCs, and even those tax-deductible family holidays, we break down how the rich structure their finances.
We're back in your life. Amanda, welcome back to the podcast.
Thanks for having me.
So, Amanda, when we're talking to clients, they're always thinking, how can we do things smarter? How can we protect our assets? What's the best way to do it?
How can we avoid paying tax? Really is what they're asking.
Move to the Cayman Islands.
Yeah, that's the one.
Can
A sunny place for shady people.
Maybe Bahamas.
Can we stay in New Zealand and move all our entities to the Bahamas and not pay tax?
No.
Okay. All right, so what can we do, Amanda?
Yeah, so I mean, the classic answer, it depends. It depends what you've got and what you're trying to achieve, right? So if you are wanting to keep things simple, you don't want to pay a lot in accounting fees or legal fees, keep it in your personal name. You can't do much about it. You pay tax at your marginal tax rate.
What's a marginal tax rate?
Your marginal tax rate depends on how much you earn.
So that's just your classic PAYE starts at like 11, then 20 something, then something, and then it's like 90%.
Do you not know the marginal tax rate? 10.5, 17.5, 30, 33, 39.
Yeah, so I mean, if you're in the 33% tax rate bracket for your salary job, anything you earn over and above that's also going to be taxed at 33%. So you've got interest, you've got dividends, you decide to go mow your mates' lawns every single week and get paid $20 each time, you're going to pay tax at 33%.
Surely that's a cashy though.
Surely that's a euphemism.
Over $200 taxable.
Okay.
Oh,
yeah.
really? Huh.
Yeah, all those
You got some stuff to declare, Mike.
Nah.
Yeah, so if you're looking at structures, so the main structures in New Zealand are a trust, closed company, look-through company, partnership, and individuals. So anything in a partnership goes to the individuals, tax at marginal tax rates.
Yeah.
Anything in a look-through company, again, the same, tax at marginal tax rates. Companies are taxed at 28%, so that sounds very nice for anyone in the 30 to 39% tax bracket. Mm-hmm. And trusts are also taxed at 39%, but then they have more flexibility.
So what is it with the overseas shell companies? Is it just not a thing in New Zealand?
Well, it's
because you always hear people talk about that sort of stuff, and we get asked about it like so many times. And I'm like, you're just going to have to pay some tax at some point. Like, is this risk really worth it? But like, what actually is it with that? Do we just not, does it not work?
So it all comes down to different tax jurisdictions rules.
Yeah.
In New Zealand, if you have a company, so if you're in New Zealand and you've got your company set up here and you're operating in New Zealand, you pay tax in New Zealand. Other companies, so like I think Google and Facebook and stuff, they're set up in countries, I think one of them is Ireland,
yeah,
and some of the smaller islands and stuff where their tax rules are different and the way that the corporate tax rates work is much different. But if you're just a stock standard New Zealander doing your business in New Zealand, you're going to pay tax in New
Right, so I can't be a Tyler and do tiling in New Zealand, but have my company registered in like the Bahamas.
Yeah, that's going to be seen through.
With those big,
I like the optimism though.
Yeah.
Thank you. Yeah,
with those big tech companies, I think it's their IP that the company in Ireland owns, and then they get charged fees, and that's how they work around it.
They're also just operating in so many different places that they do have to pay taxes in a lot of countries that don't get seen as well, but it's where the overarching companies
I think they could probably also afford the fight as well. You know, like if someone came after them, they could probably be like, all right, let's scrap, you know, like, and if I'm a Tyler on my own, could I afford to fight Inland Revenue? Probably not.
If you're an SME, probably not.
Yeah.
No.
So I think, Amanda, like a big part to understand the different structures is to give kind of real world examples. So can you talk us through a few?
The most simple ones to think about would be an individual or a partnership. They basically, if you're doing it as an individual, that's usually when you're a sole trader or quite often a first-time property investor. If you think of someone purchasing their own home and then at some point upgrading their home, they might keep the home in their personal name and turn that into a rental. Or if you're deciding to, say, invest in shares or you've got an interest-bearing bank account, that's usually done in your personal name or in a partnership because it's done jointly. Or you can also set up a partnership with IRD, which is a structure where you're electing how much each person benefits from it or taxpayer underneath. So for example, if you and your partner wanted to invest in a term deposit and one of you was on more income than the other, you might look at splitting up the interest-bearing account as 70%, 30% to two different people to take advantage of one person earning more or less.
Disappointing you, Amanda. We don't like term deposits around here. We're going backwards against inflation, but we can go through that again another day.
It could be shares, it could be anything.
Yeah.
So from there we have companies and look-through companies. They effectively, if you were to think of a company, they're the same thing. The difference being that a look-through company makes a tax election to be treated more or less like a partnership. So you set up a company with Companies Office, and there's got to be at least at maximum, 5 shareholders. So it's got to be a closely held company. And then the tax election means that all the profits and losses flow out to the shareholders. So that is used quite commonly in property investment. And the reason being that closed companies have a capital gains issue further down the line than what look-through companies have. So in New Zealand, capital gains aren't taxed at the moment. But if you make a capital gain in a company and you want to use those funds, you have to distribute a dividend. So that becomes taxable income for something that otherwise wouldn't have been taxable. Whereas in a look-through company, you can take that capital gain, do as you please.
Now that's a big one, because I do get asked that question all the time. If somebody has a business and they're at 28% tax and they don't want to take the money out and then end up at 39% personal tax rate, and they're like, surely I can just own these properties within that company so I pay less tax, but that's not going to work because when you sell the asset in the future.
Well, yeah. So 1, when you sell the asset in future. 2, if you want to use those funds for anything personal. So to jump to a company, the tax rate is 28%, but you're limited in what you can take out of a company being what you've put in. So if your company is making money and you've got a whole bunch of retained earnings, if you don't declare that as income, that money is not yours to use. So the big thing with a company is it's a company asset and it's not your asset. And that's what a lot of property investors and business owners do forget.
Yeah, it can be pretty messy, right? Like there's just expenses flying everywhere.
Yeah, so a lot of people will view, say, a company makes $100,000 in a year, they pay tax at 28%, they've got $72,000 left over, and they're like, cool, I can go out and spend that. But that's actually not correct. It then winds up that you owe the company money. And so if you don't declare a dividend to take that out, you actually end up paying interest to the company and declaring that as additional revenue in the company for the use of the funds.
If I own 100% of the company though, is it just like I'm charging interest to myself? Is there any real...
So it's not smart upon is the simple way of putting it. And you're charged interest on it at a pretty high rate. So the interest charges to it then just accumulate over time. If people do that in order to distribute dividends at a future time when their personal income's lower, but really good management would be that you're distributing the dividends at the time before you're using the funds out of the company.
Oh, okay. Well, let's jump to trusts, because trusts were very fashionable. I remember at a Westpac conference back in the day, they asked everybody in the room, put your hands up who has a trust. And there was a period of time, I don't know if it's kind of eased off a bit, where trusts were just very fashionable and everybody kind of had a trust. What are the benefits of having a trust?
They used to be really good for money laundering too, because the AML around them was like practically nothing. I remember I said this before probably on the podcast, but I had a podcast in London about financial crime, and it all finished, and they were like, okay, so like everyone vote for what you want the next one to be, and it was like Monaco shell companies or like New Zealand trusts. And I was like, wait, what? And like apparently they were like that well known globally for like you just throw whatever in there, it doesn't matter.
Yeah, so I mean New Zealand has had slightly looser rules than other countries around trusts, and just around how much you had to let IRD know if you were an overseas buyer or investor. That's kind of all changed in the last 5 years as the rules around it have increased. So a trust is a structure that's set up basically to benefit other people. So when you set up a trust, you have a person that sets it up. They're known as a settlor. Other parties involved are as trustees who are controlling the assets of the trust, and then the beneficiaries. And they're the ones that are designed to benefit from the trust. And those people are at the discretion of the settlor. So James, for example, you might set up a trust and you might have the trustee being yourself and say one of your family members. So they're the controlling ideas behind it. And then the beneficiaries could be yourself, probably your son, and then maybe one specific nephew or something that you want to, probably Mike, that you want to benefit from it. And unless you decide to add someone else to it, no one else can benefit from that trust, because that's kind of how it's been written in. And the reason people use trusts is mostly for asset protection. So lots of family homes are owned in a trust, because that's just kind of setting up the way that they want their assets to be treated in the future, maybe when they're not around, or maybe when they're in a position that they can't decide things. So quite often your trust would go hand in hand with how your will is written. And then people also like them for tax purposes. So 2 reasons. Previously, the trust rate was 33%. It's now being increased to 39%. So there was a small lag in the New Zealand tax system where it didn't match the top marginal tax bracket. It now does. But you can also allocate income out to different beneficiaries. So if, for example, husband and wife have their investment properties in a trust, or they've got their business shares held in the trust and dividends into the trust, and say the husband's not earning as much, you might choose to distribute out profit at the end of the year to the husband so that they pay tax at their lower marginal tax rate. Whereas if it was kept in the trust, we tax at 39%. So,
awesome. Yeah, one other thing I'm keen to hear from you, Amanda, is obviously there's the tax perspective, but like you mentioned, there's like kind of the legal protection of assets as well. I'm keen to hear your thoughts after this break.
If you're enjoying this episode and you're not 100% sure your financial structure is working for you, talk to the team at Lighthouse Accounting. Whether it's a trust, look-through company, or company setup, we'll make sure it aligns with your goals and keeps more money in your pocket. Head to our show notes to book a chat. Now back to the episode.
So Amanda, a lawyer is going to be sitting down with their clients and talking about, we need to do these things to protect your assets. But then you're going to have a perspective as an accountant to go, well, here's how we minimize tax. What is the priority? How do we work through those?
Yeah, so I mean, if we're looking at it from just a legal perspective, we'd take the most likely the advice of the lawyers first. And the reason being that they're probably seeing a lot more of the picture than what we're seeing. So in the accounting world, right, we talk to tax, we talk to accounting, we don't talk to everything else because there is a limit to our expertise. Your lawyer's probably more aware of, like, say, where your will's at, maybe other parties involved in your structure. Say if you had been through a divorce or something, we might not know that. So if a lawyer's telling you to do one thing, we might tell you the pros and cons from a tax perspective of the different options, but we wouldn't override the advice that they're giving. If we are the first, like if the accounting team is the first people to be interacting with you about structures and what you have going on, that's when we kind of ask the questions about what's going on in your life, what's your position, who are the other parties involved, like do you have children, are you likely to change into a role that's got any sort of exposure, do you want to set things up for your children later in life, all that kind of stuff. And that kind of guides whether someone might benefit from being in a structure or being in just staying simple and personally held entities. So it comes down to a little bit as well whether they're going to get the benefit from tax savings with the additional costs that go with having structures. So if you've got a structure, you've got a lot more reporting to do than what you have as just a person owning your investments. So that kind of dictates what we'd decide to do depending on the person.
Yeah, and I guess maybe you pay, potentially there's a little bit more tax or there's some implications, but if you crack open a relationship agreement or if you're a builder and there's liability and you're making changes, the impacts on that side can be way more.
Yeah, well, like, I mean, if you're, say, for example, starting a business next week and at the moment it's just going to be you're going to be a sole trader, you're going in as a wealth advisor, say, but you also know that you have plans to keep doing this for the next, 10 years or so. And you also expect that you're going to need some staff, you're going to need an office space, all that. You might only be starting out as a really small business, but your long-term plans align with the fact that you should structure that through a company.
Awesome.
And get that correct.
And coming back to the splitting of income between partners, so the right structure for that would be a trust. Is that
a trust or a look-through company.
Okay.
And a company. It depends what you're doing and how you're wanting to structure the income. So if you always knew, so let's say we're talking about property investment, if you always knew that one partner was going to be a lower income earner, you're going to want to be setting it up so that you could get more profit out to the person that's the lower earner. And you can do that both through a normal company, a look-through company, and a trust. A trust has the year-on-year flexibility, whereas a company or a look-through company is based on the shareholdings.
Yeah. Do you run into it quite a bit where there's one high-income earner, one low-income earner or no income, and it's not set up the most efficient way?
Yeah, so it does. It happens quite a bit, especially with older structures. So if you go to look-through companies and companies that were set up back when you could claim, when residential property losses were able to be claimed against other income. So people used to set it up so that the higher earning had, say, 90% of the shares, lower earner 10%, and then there were some big tax refunds that would come out from negative gearing. That got closed off maybe 2020, so 5 years ago now, but lots of those structures still exist. And if those properties are now making profits, that's all being taxed at 39%.
Man, that'd be good times, eh?
Yeah.
Oh, imagine that. Oh.
I smile because I know you guys still get asked. You're like, oh, we have to pay tax.
Yeah, the amount of new investors who in their first year make losses and they're like, "What? Where's my refund?" Sorry, that door's been closed for a while.
So, Mike, we've got these different structures. From a lending perspective, does it make a difference to the bank?
No, not at all. I mean, all of these, you're looking straight through to the person anyway. Where people do get caught out is when they put their parents or family members down as a trustee, but then they are also named as a beneficiary. And that might be because it's a discretionary or a non-discretionary trust. They might be named or they might be part of a group. At that point, your trustee is not a professional trustee, but is a trustee and beneficiary of the trust. So they have to get assessed for the lending.
I follow that, I think.
Short of the long is if they're going to be a professional trustee, my advice to you, you can use your parents, but just use someone from the firm that's setting it up.
Yeah.
It's much clearer for the bank. That's the only time, because everything else with lending just looks straight through to the people anyway.
I think the only other thing to that, though, is just the timing with the banks. It usually, from our experience, if you're buying something through a structure and you have been doing all of your assessment through yourselves personally, and at the last minute you're like, oh, I've just set up a look-through company or I've just set up a trust, the banks are a little bit slower because they have to run an AML on everything and do it all over again.
It can take 2 weeks to onboard a company.
Yeah.
Like a look-through company at certain banks. And if you're going to do that, just think about the purpose of the transaction. Is it an investment property? Am I going to put this in an entity? Yeah, let's maybe do that a little bit earlier in the piece.
So we've got these different structures. I mean, I live in this world and I still find it confusing. What are the common mistakes and how do we avoid them?
Common mistakes probably just starts from the street advice. So your friends...
Sounds exactly like financial advice.
Yeah.
I'm not going to buy a property, Mike. I'm going to go invest in some gold.
Mate, meet me
I
under
wouldn't
the
mind
counter.
that.
Do you know Mike said to me this morning, oh, stock market's down, James. I think I'm going to go buy some stocks. And I was like, Mike, no, just focus on paying down debt.
We do get a lot of, my friend's got a trust and they went on a family holiday to Australia and it was tax deductible. And you sit on the other end of the call and I'm sorry, your family holiday is not tax deductible.
Also, that's just straight up tax avoidance. Like don't do that. Cool. You might get $1,000 back in tax. I mean, who cares?
If you were to get audited,
like Jesus.
Yeah,
totally. So I mean, the wanting to have a structure because everyone has a structure doesn't work, right? It needs to be the right structure for you. Setting up a company and you think it's a look-through company is one we've had quite a wee bit. So you can set up a company really easily. You can jump onto Company's office with a RealMe account. You can set up a company. You have it within 2 days. That's not a look-through company. So that makes a big difference for people who do that and then they've bought properties and they've been, doing their accounting themselves for 2 years. They actually get an accountant and they're like, oh, it's a look-through company. And you take one look and it's not a look-through company. Suddenly you've got 4 properties. Down the line, you're going to have capital gains issues. You're going to have dividend issues that they're not expecting. The other one is, I guess it also comes back to wanting to do what other people are doing is setting up a structure that, say a trust, for example, kind of costly, not managing it correctly, but also not really having a need for it. So if you are managing it correctly, you're probably spending somewhere between like $2,000 and $10,000, depending on what's in there. But if you don't need that structure, that's a lot of money to be spending. So it's really about figuring out whether the structure is going to help you, help your family, help the investments that you actually have.
Is that 2 and 10 the setup cost, is it?
No, sorry. So I mean, the setup cost would be between like probably $2,000 and $5,000, depending on where you go. The accounting fees for ongoing and like the compliance costs. And if you had a professional trustee involved, they have to do reviews of it each year, see that everything's up to their standards as the professional.
Do you see many trusts not being well managed?
Yeah, heaps. Especially.
And what are the risks around that?
So the risks around it from a tax perspective is that you're not complying it correctly with IRD, and the tax rates change if you're really not meeting it. That's not that common and much hairier, so I'm not going to go into that. The main thing is from the legal standpoint of where beneficiaries are able to kind of come after the trustees for not having correctly managed the trust assets. Or the other one is actually that a trust can be seen as scams. Scams or shams? I think it's shams.
A scammy sham.
And so if that's the case, then basically if you thought you were using this trust for all these tax savings and suddenly it's seen as a sham and then it's all personal income, that might just completely debunk your entire saving strategy for taxes. But not common again.
Yeah. I assume that's how Mike's going to go down in the end, in some sort of sham or scam, but we'll work that out another day. Any other situations you're seeing where clients are making common mistakes?
What if I am operating in New Zealand?
Operating what?
Like I have a company in New Zealand, but then I don't want to pay tax. So I have another company overseas in like, I don't know, the Bahamas or some tax haven, right? I get all the profit in New Zealand, but then I'm like, okay, this company over here is going to insure me. And then what I do is I go, cool, I made $30,000 of profit. So I get you send an invoice for the insurance for 30 grand to an offshore company. Would that work to shift their profits out of New Zealand?
No.
Damn.
What's your invoice for?
So the company in like overseas is insuring the company in New Zealand.
Yes, it's an insurance invoice.
Yeah. So then it's a cost here, but then you get the money over there.
So no, the reason being that to be able to claim expenses for anything, there has to be a connection between the income that's been derived.
Insurance.
So yeah, but like what are you insuring?
Do you know what it makes me think about when we went and did that seminar and we got 1,000 questions about how people can get
their
access to
Kiwi
their
Saver.
Kiwi Saver?
Yeah.
And it's just you and me just being like, how do we not pay tax?
Yeah.
Like, you can raise as many invoices in a company's name as you want, and you could absolutely claim them if it gets looked into and it's just because you've been trying to avoid tax. The penalties and the outcomes of that aren't great.
Okay.
And that's the big one with a lot of this, Amanda, right, is as I've heard from Matt Harris, it's a voluntary system, right?
Yeah.
And you can actually do whatever the hell you want.
Yeah.
It's just whether somebody starts looking that you're screwed.
And over over the last forever, right? The scrutiny and the review of people's information and areas that IRD decide to audit change all the time. So different industries kind of get looked at every couple of years to see if they're doing things correctly. So if you're not doing it correctly and it gets caught, it's not a nice outcome.
Yeah,
so
and I've heard that
right.
Inland Revenue have recently kind of stepped up the ball game in terms of auditing, reviewing. They're now using technology to do it, whereas instead of just going and looking at people's books. So everything's a bit more automated, which just means it's not worth the risk.
To wrap up, Amanda, one last question for you. If there's people listening and they think, I don't think I've been doing this as well as I should, and there's that whole kind of, I'm a bit worried about what might happen, what would be your advice to them? Yeah,
so the first thing, if you don't think you're doing something right, is to get in touch with an expert. And then the process from there is if you have realized on your own that you haven't done something correctly with your taxes, you can do a voluntary disclosure to IRD. You basically say to IRD, I've made this error, this is how it's occurred, this is how many years it affects, and this is what I've done, and this is what I should have done. And here are my regenerated accounts that have been corrected. This is the difference in taxes and what I should have done correctly. Like, please, I'm presenting to you my issue. Like, please help me.
Surely IRD takes a fairly positive view on that, so long as it's a genuine mistake, where it's like, hey, let's sort out a payment plan to work this back, as opposed to them finding you and then being like,
so
you're just avoiding tax.
If you get found making an error and then try to plead the fifth, it doesn't go as nicely. If you set it up as a voluntary disclosure, there still might be some interest and penalties, right? You've still benefited in some way from not having, say, paid as much tax as you should have in the first instance, but it's not as high in the interest and penalties and the ramifications that could happen.
Yeah, and you can work out, and in terms of how you approach the idea and all those sort of things, I'm assuming it's very common for an accountant to help you work through that.
Absolutely. We usually would manage the entire process with IRD.
And if it's quite a large sum that you potentially owe, I assume payment plans are pretty common? Yeah,
payment plans. You can do a payment plan. Even if you were like a regular person can do a payment plan back to IRD, and they're very open to that, especially if you forefront the fact that you want a payment plan.
Awesome. Well, thank you very much for your time, Amanda. Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to the channel. Give us a review. Give us a like. And we'll catch you next time.
Cheers.